Welcome to the show this morning. It's a real honour and a pleasure to be interviewing a long-standing friend of mine, Mark Hipperson. How are you feeling this morning? You good?
I'm good, thank you very much. Yeah, good. Glad it's Friday as well, as has been mentioned so far.
Yeah, you know it.
It's been a tough week.
I had a really tough one. My little boy was sick last night, so I've barely slept. So I'm hoping you're going to survive.
I remember those years.
This one. My questions are going to be scattered all over the place. But today we're going to be learning as much as we possibly can about banking. I have so many questions from previous guests. We're going to talk about crypto. We're going to talk about FX. We're going to understand how the banking system works. And if you wouldn't mind, could you give a little bit of a background to people listening, what your involvement with banking has been? What's it been like as the founder and CEO of Ziglu? Talk to me about your history, especially when it comes to traditional banking first.
Okay, well, I'd like to think I'm a technologist first and foremost. So I did computer science years ago at uni. Then I went on to Barclays Bank, where I worked my way up through branch banking and regional office banking and head office banking, and ended up running technology for Barclays UK. And then I left to found my first technology business, which I sold in 2003, ran a consultancy for a few years, and then I founded Starling Bank, which is one of the challenger banks I think many of your listeners and viewers might have heard of. And that was in 2014, 2015. And then after that, I founded Ziglu, which is how do we evolve, challenger banking into something more 21st century, more how do we get different asset classes and crypto and things like that onto the platform as well, not just fiat currencies.
Take me back to when you were in the traditional system. What was it like if you take us years back working in a sort of traditional brick and mortar big bank? Is it as murky as people tend to assume, or tell us what it was like for you?
Well, the pros are you learn a lot of good stuff. They invest in individuals, as it certainly did back then. So I learned how to do project management, how to get delivery done, how to deal with politics and bureaucracy, and all the things that you might expect are quite useful. And some of the things I have challenges with nowadays when people come into my businesses, they don't always have the background of banking and understanding what good looks like in terms of behaviours, in terms of how to deal with people. And they were quite formative, some of those things, in terms of how do I work through the environment, trying to get the best out of people, whilst trying to make sure that we get delivery done in everything that we do. So it was a useful period of, I guess, 10, 12 years or so. And I kind of I also learned that I don't really like banking and some of the people I came across. They were, the behaviours were quite selfish, and they weren't customer-centric. And I think what we're seeing nowadays in many of the companies that are successful globally is they have a totally different customer-centric attitude, not just about the standard things you'd expect regulators to be concerned about, which is transparency more than anything and being open and honest. It's about being fair and moral. Words that aren't normally talked about very much in business, but and certainly not in financial services. But those intrinsic values of human beings, I'd like to think are more pervasive in some of the more the newer companies, the newer banks, that certainly the challenges, and I'd like to think the businesses that I'm involved in, which weren't certainly the case, or is not the case in traditional financial services.
Is that part of why you went to help start Starling?
Totally.
So talk to me about the transition. You're in this traditional system, you're seeing a lot of issues or problems. What were those problems, and what do you think the solutions were that you brought to the table when you were developing what you call a challenger bank?
So back to the point of being fair and reasonable. You can have an authorised overdraft with Barclays and they'll charge you 30%. That's when they think you're a good customer, you're authorised, and interest rates are low. They can be really low. So they're taking money in and they're not paying you any interest on it, and they're charging you an exorbitant amount of money to be overdrawn on an authorised overdraft or on a loan. For me, that's immoral. They may be transparent about what they're doing, but it's a bit of a cartel. All the main banks charge a similar set of interest rates, and it's just not fair. So one of the things that I wanted to do is, when the opportunity arose, the EBA, the European Banking Authority, empowered local regulators, in our case, the FCA and the PRA. The PRA is a Prudential Regulatory Authority, which is part of the Bank of England, to try to introduce more competition in the banking space. You're not going to move across the road to go from Barclays to a Lloyds because they're as bad as each other. So how do you aim at that younger demographic became a little bit disenfranchised by banks. It's sort of 18 to 35, 18 to 45 demographic that live their life on the phone. You know, the sort of people that you find walking across the road, AirPods in, not looking left and right, but on their phone. Like, please look up. You know, you're going to get run over. Those kind of people. We're all like that to some extent, of course. But how do we provide a bank that sits in your palm that is really good in terms of customer service, that allows you to feel in control of your money, that it's your money and you can spend it the way that you want to spend it, and is something that the younger demographic want to try to engage with. So savings pots and helping you save money by reducing any debt that you might have first before you then spend money on coffee, for example. So tips and hints and things like that. So the concept was always to try to be fairer, charge better, more reasonable interest rates, and do something that we thought that demographic would engage with and enjoy, and put the power back to them. So the likes of I guess Starling and Monzo and those particular banks, there's Revolut and Ziglu now that aren't banks as such, but certainly provide banking type services, have gone some way to try to readdress that balance. And I'm quite proud of what we've achieved in doing that.
Well, one question I have, if I take myself back to my uni days, I remember that moment where you go a couple of quid overdrawn and all of a sudden you get like a flat fee of 30 quid. So just to
and worse than that, what they would do actually, Mark, they would write to you often and tell you went overdrawn, and every day they've been charging you £30. Yeah, so they don't tell you straight away. They let you run up multiple charges, and then you could be a couple of £100 overdrawn by being a few pounds. It's wrong. It's inherently wrong.
So one question would be, if I've understood this correctly, prior to this new emergence of, let's say, fair competition from these regulators, was it the case that these banks were just kind of in cahoots? Because you could charge whatever you want within reason. You could just say, well, that's why you can't maybe call it a cartel. If someone's gone £1 overdrawn, and all of a sudden they're getting levied with a 30 quid default charge and maybe 2 quid a day, it's like, what makes that legal? And can those banks just charge whatever they want to?
Yeah, it's as long as they're telling you they're charging you, they can do it. And this is what I think is wrong with it. So whilst a regulator is there to try to regulate and make sure people follow the rules, if they set the rules and their T's and C's, that if you do this, we will do this, it's fair and reasonable, it's transparent, but it doesn't make it right.
And the regulators don't have a vested interest in reducing those fees and bills?
The regulators are encouraged to make sure that financial institutions are transparent and open, so that you as an individual can choose where you wish to bank. Now, Monzo and Starling particularly have won Which Best Bank several years in a row, because most people, certainly the younger demographic, realise that they're fair in terms of their dealings towards you. But there still is this misperception that some of the bigger banks are still better banks in some ways and safer. They're all banks. They all give you £85,000, if they fail as banks, but they're very unlikely to fail.
I want to pick your brains on what you're doing with Ziglu, because I think your story is particularly interesting in the development of that company, and I'm kind of keen to get into that. But before we do, especially for the sake of my listeners and myself, I've got this lovely opportunity to ask you some questions over the next hour or so. Can anyone just be a bank? And what I mean by that is, companies apply for their licenses, and I get it's regulated, but there's these magical powers that banks seem to have that anyone else would get thrown in jail for, whether it's quantitative, not necessarily quantitative easing, or double spending, or whatever. So what's it like for you as an entrepreneur building a business in a regulated environment like this?
There's 100 questions in that one question.
I'm going to start with then, can anyone start a bank?
In theory, yes, but in practice, no. That's a wishy-washy answer, but I'll tell you what I mean by that. What I mean by that is, you have to go through a number of tests to make sure that you are a fit and proper person to be able to running a financial institution. And many of the problems we've faced in global financial services, certainly in the crypto elements of that over the last 2 to 3 years, have been because of poor governance and people that have found themselves in charge of other people's money without understanding the responsibility that comes with doing that. And the biggest example, the most obvious example is FTX and Sam Bankman-Fried. So who's paid the price of not really understanding and what's the responsibilities of having that role and that responsibility. So you have to so back to that original question you gave me about what was it like in Barclays. It was really useful to work in an environment where the focus was on security of other people's money and doing everything you can to make sure that you realise the responsibility that you have as a bank to look after somebody else's money. But then it's once you, and we've been through as a company a failed acquisition where we couldn't pass control over to a third party company because our licenses are pretty strict and the regulators are pretty strict about who is entitled to be in charge of certain companies which are regulated, of course. So you have to be what's referred to as a fit and proper person. You have to have the right experience, and you have to ensure that not only the CEO, but all the exec team, all the sort of what we call senior management functions are experienced, and no criminal record, the obvious things that you'd expect, but also capable to do the job. And you get interviews by the regulators to make sure that they believe that you are the right person to be doing that role within the bank.
Those regulators are the ones that then either assign the green light or the red light on whether you can function as a bank. Here's a weird question then. Let's say that I was deemed a fit and proper person. Could I make my own bank and run it as a one-man band?
Well, no, because you could be a member of a team of a bank, but you need multiple functions to run a bank, from risk to compliance to finance to the person that leads from the front, the CEO, and most modern banks have a really important technical function. Starling and Monzo built their own banking platform, for example, as did Ziglu and Revolut, I believe. So you need capable people in each role, and you need multiple capable people. And one of the key things that regulators look for is, do you really understand how to ensure that your compliance function, your risk functions, and your ability to manage risk are really understood? And people kind of take for granted that the banks, inherently know how to do all these things, and why is it important? But it's fundamental. Back to Sam Bankman-Fried and FTX, that you understand how to take responsibility for someone else's money and the movement of money around, and what's legal and what's not legal, and AML and KYC rules. So AML is anti-money laundering, and know your customer rules about moving money around and knowing that the law in relation to those banking features and functions.
There's a reason I take this line of questioning in a way, because I've always struggled to understand this idea of double spending. It's actually what got me into crypto years back. I never understood that it was possible that you would put £1 in a bank and that bank would be able to utilize that pound to many other parties, essentially multiplying money out of nothing. How does that work?
So there's kind of two levels of QE, quantitative easing. The government does it, and I think it was the UK in 1931, removed what's called the gold standard. So they could effectively print money.
And when you say that, you mean because it used to be the case
that
money was pegged to gold, i.e. you had to have the gold to back up the pound?
That's right.
Why was it removed?
It was removed because there was a desire back in 1931 to try to prepare for a war I think they thought was coming. And in doing so, they couldn't set the factories up and buy the machinery and buy the planes and get ready for that. And we didn't have enough tax income. So it removed the constraint on having gold. I think it was later, 1971 in the US that they did that. But there's very, very few countries, to my knowledge, none anymore, that rely upon anything other than the rating of their country and the general supply and demand, which comes back to the rating of the country, to be able to effectively print money. So what that means is issuing treasury bonds and gilts and things like that as a country to say, we're good for it, we're good for it, we're good for it. Not every country is good for it, but the US and the UK and other European countries, generally EU countries, are considered to be good for that money, i.e. when I go to a bank, I can spend it and I won't have massive inflation. So countries can do it, but also banks can do it as well, which is a kind of a strange rule. And not many people know about it, really. That the fact is that if you are what we call a CMA9, the Competitions and Markets Authority main 9 banks and 13 brands, then for every £100 that you put in there, they can lend that out multiple times. Now, there's no real...
Twice? 3 times? 4?
10 times plus. There's no real limit. The balance sheet is their only limit. Their own discretion and balance sheet is their only limit. So you put your £100 into your account, or let's make it £10,000, and you might get 1 or 2% interest on that if you're lucky in your savings account. But then the bank can lend that out to people who go overdrawn, authorised overdrafts, at 29 and 39% multiple times over. So that one £10,000 deposit can be lent out 10 times at 29.99%, bringing all that interest income into that bank when they're paying you effectively nothing for that. But it's okay because it's transparent, because that's what we're doing, according to the banks. Kind of unbelievable,
yeah,
but totally true.
Many people listening to this conversation will be wanting to ask, how is that legal? How is that allowed?
It's kind of a loophole that's been in place for years and not really talked about, but the government, the UK government, enables that to happen, to provide liquidity in the marketplace, because the whole country's in debt, both in an individual perspective and a countrywide perspective. And if that was to stop, the whole economy would start contracting, and getting smaller, and the country would suffer. So they allow it to happen. What they're trying to do in the background is put some constraints over it, but those constraints haven't been implemented as yet.
So if I've understood this correctly, our government removed the pegging of the currency to anything of intrinsic value, so it's just paper now.
Mm-hmm.
And there are certain infrastructures that are allowed this magical ability to multiply it from thin air.
And they're not the challenger banks, by the way. It's only the more traditional older banks are allowed to do this. Challenger banks still have to follow kind of far more restricted ability to be able to lend out. And they're tailored per bank, depending on the application and the general management of that bank. So the challenger banks, and there's a few now, if you look at Starling, Monzo, Tandem, Oak North, Atom, those kind of banks, the newer kind of banks, they've all got Shawbrook. They've all got some restrictions on what they can lend out. They're not like the main banks, and kind of, the CEOs of the challenger banks are clearly quite concerned. Why are these double standards? Yeah, it shouldn't be fair. And I just think that it would appear that the government realises we've got a kind of an exception in place here. Not everyone knows about. And we're not going to make a big song and dance about it, and we'll try and restrict the main banks in due course. But at the moment, if we were to do that, it will have a knock-on impact on the economy. And you can see, in terms of the last budget that we saw, that our borrowing costs as a country have gone up as a consequence of the decisions made by the Chancellor, because there's some lack of confidence in terms of the government. Therefore, lack of confidence in the government means that our borrowing costs go up, because people are thinking, okay, is this, because we've got no goal behind it, it's as good as the country, and are we making the right decisions? Are we, is it inherently right, and is it the right thing to be doing to be raising taxes on business, because that restricts our ability to be able to take people on, and might make you think, have I got too many people at the moment? So it inhibits growth in businesses, which generally is considered to be a bad thing. Therefore, it affects the country's ability to borrow. Therefore, interest rates on what the country's borrowing go up.
This is what I find fascinating about your ability to break down what is quite a complicated subject for many of us into these more straightforward building blocks. Because if I've understood what you're saying correctly, where the currency is, let's say, depegged away from anything of intrinsic value, we are all just operating in a debt system where the pound is just worth what we believe it's worth, right?
Supply and demand. Yeah, exactly.
So,
like houses. So houses can gain value and lose value because of supply and demand. I.e., if we kick out lots of people in the UK because we're raising taxes, we're increasing capital gains tax, inheritance tax, people and generally employers' tax and employees' tax, people will leave the country. Therefore, a smaller pool of people will be left to pay the taxes. Therefore, generally, when tax rates go up, tax income goes down. It's kind of a relatively well-known thing over the last 100 years or so. We've seen that in the UK. So those kind of policies have to be balanced against what is the right thing to do to employ people and keep money moving around in a way whereby we can employ more people as companies. At the moment, we've got probably a higher level of unemployment than we want, yet the decisions recently made will inhibit businesses wanting to grow.
Well, especially if your employer's national insurance starts going up and it gets...
Yeah, not that I want to get political, of course.
Yeah, exactly. But okay, well, for me, when I was trying to understand this topic, this is what originally led me to crypto. Was it the same for you? Because when you see things like Bitcoin and you realize, well, all of a sudden we might have a transparent ledger where it's impossible to double spend a Bitcoin, for example. Yeah. Was it a similar leap for you? Or were there other reasons why you got involved in crypto specifically?
Well, cryptocurrency are all different. I mean, ultimately, they're businesses, technology businesses under most of those cryptocurrencies. Bitcoins are kind of the one exception whereby it is limited to 21 million Bitcoins ever. That's all there'll ever be. Therefore, you have a limit, which is kind of like nowhere else. No other country has that kind of limit. Therefore, it comes back to supply and demand. There is only limited supply. Therefore, demand is based upon people's willingness to be able to use that as a means of asset accumulation. I.e., at the moment, we've seen certainly most notably because of the fact that we've got three, what I say, major events that have occurred in the last year or so. We've had ETFs, exchange traded funds, being quoted on the US stock exchange, which effectively enables pension funds and high net worth individuals in the US to be able to invest in crypto on the US stock exchange.
Does an ETF buy the actual crypto? Yeah. Does the ETF actually hold it? So it doesn't just go based on the value? Yeah. Interesting. Okay, so an ETF is an exchange traded fund? Yeah,
that's right. And you can put anything into an ETF, but now you can have crypto ETFs, which is the first time the US have done that, and it's great. It means that it's legitimizing the cryptocurrency for the first time. So that was one key thing that occurred last year, and then, or very early this year. And then, obviously, Trump, big supporter of crypto, and Musk, big supporter of crypto, aligned going forward from next year, and that's had a massive effect in terms of the legitimacy of it, because I think people were uncertain of, will it get support, will government support it? Governments inherently don't want to support it because you can't tax it quite in the same way, of course. The movement, you can tax fiat currency, but you can't tax cryptocurrency in the same way, although inherently in the UK you are obliged to pay tax on your cryptocurrency gains. Of course.
When you change the cryptocurrency back into fiat, or just in general?
Yeah, so any capital gain you are obliged to report because it's an asset. So as far as the UK is concerned, we consider it an asset class for tax reasons. So therefore, any increase in value in that, you're obliged to pay capital gains tax on that.
So if I bought a Bitcoin for £1 many moons ago, and now it's worth 100,000. But I leave it on chain and I don't liquidate it into pounds or dollars.
You've not realised your gain at that point in time.
So that's only on the. And what if you lose it?
I don't know the answer to that question, Mark.
Okay, so for you, it was a similar jump. You were realising that crypto was solving problems for the general public.
Well, it wasn't just for me. For me, cryptocurrency is an asset class, but it also the reason it was not just Bitcoin, but all cryptocurrency was established was a means of being able to move money around without necessarily oversight of governments. And we can see now, I mean, no matter what your view is of the governments worldwide, you can see governments fall. Syria recently, most recently, and the people that end up in charge of a country aren't always the people that you want to be able to know everything about you and where you go and what you do. Is that fair? Is that reasonable? And your ability to be able to say, with cash, I want to pay my window cleaner in cash, or I want to be able to pay my son or daughter some money for something. Do you want your government to be able to track everything that you do? And they can with CBDCs, which we can talk about at some point if you wanted to, and they can with the movement of fiat currency. They can't with cryptocurrency.
I have to ask, what does CBDC stand for?
Central bank digital currencies. It's one of the things that...
I see. So the digital pound that they want to implement.
Exactly, that's right. Okay. I mean, one of these things... I mean, I don't know if we'll have a chance to cover it today, but it's one of these things that I know that a number of governments is considering implementing at some point. China do it, and what they can do is, trace... Everything that you do, and wherever you spend any money. It can be £1, it could be £10,000, but they know exactly where you spent it and what you did with where the money came from, etc. It provides traceability, and the reason that governments don't like the movement of cryptocurrency is, as far as they're concerned, and to some extent it's true. It removes their ability to be able to see where the money came from and went to in all cases. You can take something off in terms of your Web3 wallet or a hard drive and put it somewhere else and move it somewhere else. They can't see where that money went to and who it's going to. So there is AML concerns for terrorism and things like that, which are legitimate concerns. They genuinely are. Hence the reason why all financial institutions in the UK and technically globally have to follow defined standards on AML and KYC, i.e. if I was to send you £10,000 via Barclays or any major financial institutions, even Ziglu, we would need to ask the questions on why are you doing that, what is that for, and make sure they understood me and understood you, checked us both out to make sure we weren't into money, we weren't into terrorism or weren't into anything we shouldn't be, to ensure that we followed the rules of the UK. Now, you can't do that with cryptocurrency. But now, with the way that regulated or registered exchanges are, so we're registered as a crypto asset firm in the UK, we have to follow the same rules we do for fiat currency, i.e. pounds and dollars and stuff, for cryptocurrency as well. And most of the exchanges that are able to take customers on in the UK have to follow the same level of rules for anti-money laundering as well. So there's no difference, actually. We all have to follow those rules. The problem is, if you were to take your cryptocurrency off chain, let's say, and go elsewhere with it, they can't trace that money, and that's what the concern is. We don't allow that as a business, by the way, so people can't do that with us. But so we're quite open and transparent and clear in terms of what you can do, what you can't do. So there is a legitimate concern that this money can be going anywhere, and no one really knows where it is, and it's more than just an asset accumulation means, a cryptocurrency. It's also the portability and movement of money what people are concerned about.
It sounds to me like you sit quite firmly in the middle of understanding the traditional banking system. You seem to have your awareness and sympathies for the challenges that they face. Yet you are diving and pioneering, I would say, especially in the UK right now, you're pioneering the movement and the support of regulation and implementation of crypto in the UK. Obviously, you're building an app that does that, and you're kind of bringing Ziglu to the masses from the UK and potentially around the world. A good question for me would be, why? Like, what are you trying to achieve? What is it that you want to do here?
So, when we did Starling, it was great. It made it. I'm quite proud of what Starling Bank is, but because it kind of changed that younger demographic's relationship with their bank and put them in charge for the first time of their money. They got notifications. We implemented for the first time, spending on cards and getting the notifications through for spending on cards and freezing your card and all that sort of stuff. Things that we take for granted, sort of, I guess, 10 years on now in many ways. But back then it was like, reading the API specs and making sure that we really understood how it all worked and it could implement things that hadn't been done before. So giving notifications and getting a better level of engagement with our customers. Now, okay, but it's still one-dimensional banking in many ways there. So where will it go, and how do we make it more interesting and better? How do you get some exposure to cryptocurrency in a way whereby you feel that you can put some money into it? It's not just about putting everything in there, but putting some money in there and thinking, okay, well, I want to ride this wave a little bit, but put some money in it. I know I've got bills to pay, and I've got other assets and things I want to put some money into, and I need to put some money in my pension, all that stuff. Of course you do. At the same time, why should you be denied the ability to be able to do the things that only high net worths in the US can do? Because it's not wrong. It's not right. So being able to put £100 into crypto every month is not unreasonable. So we enable that, and we enable that through a way whereby you can get exposure to the fluctuations in different cryptocurrencies. But it was always, for me, just one of a number of asset classes we were going to implement. So we were always going to do stocks and shares, US stocks and shares, and UK stocks and shares, and tax wrappers and all those things. But when we launched in June 2020, we were the first retail company, B2C company in the UK, business to consumer company in the UK, that enabled people to be able to do that. So we were registered for crypto assets, so you could buy and sell crypto with us, and we were also registered as an EMI, so you could effectively do banking services with us as well.
And EMI means
an e-money institution. That basically means we can handle your fiat currency. We have banks behind us that the money sits with, but we move that. You can do payments with us, you can do cards with us, you can do FX with us as well. Another problem in the UK industry where banks ripping people off. So we do all those things to try to enable you to do a number of things in one place, not just traditional banking, but you can do crypto and you can do stocks and shares and have a bit of exposure to Amazon or SpaceX or Nvidia. SpaceX is a bad example because it's a private company. Nvidia or Coca-Cola or Microsoft. Just buy half a share or £500 worth of stuff. How do you do that? Well, it's difficult for many people to be able to do that alongside cryptocurrency, alongside their fiat currency. So we've kind of enabled that, and that's kind of the things that's how we evolve what a one-dimensional banking platform such as Starling into something that is more of a personal investment platform.
There was a tiny little nerve touch there about the FX.
Yes.
What was that? What do you mean?
Banks still rip people off. It really annoys me.
In foreign exchange?
Yeah, Amex is the worst example. So you go away on holiday, and I don't do it anymore, but I used to. I'd go away to wherever, and I'd pay half the bill on my Amex card and half the bill on a Ziglu card, and look at the difference in terms of what it's costing me. And not only will they give you a worse interest rate, this is your bank, or it's Amex, or it's one of these other cards, but they will also charge you a commission invariably as well. So you get a worse, a hidden, a non-transparent rate that they'll make up on the fly.
So if it's $2 to the pound, they might say, oh, actually, you only get $1.8 to the pound. They make up a rate to get a margin there.
That's
so
right.
I wouldn't have thought that'd be legal.
Well, no. But they've been transparent about ripping you off, so it's okay, Mark.
Right, okay.
Yeah.
Well, it's good for people to learn, right? Because honestly, we don't think like that. We go on holiday, we just go, well, that cost us 20 quid. Yeah. So they actually put a margin in that exchange and they hide it in there.
Yeah.
And they charge themselves a commission.
Mm-hmm. Not all of them. Some of them will charge a commission on top. Others will just hide it in the exchange. So when you buy and sell, go to the airport and look at TravelX, and then you compare it to Ziglu, for example, what you get on our app, you'll see a massive difference in terms of what they're going to charge and what we charge, because it's all very transparent with us. Our FX is effectively free. We give you the best rate that we get. Whereas if you go to TravelX, the whole business is around zero commission, but the spread, the money that they're making on you between the buying and selling is enormous.
When there's tools out there that give zero costs when it comes to FX, you're essentially, I don't want to call it a scam, that's too negative, but you're kind of blowing the lid off this old heritage business where people have just been getting away with murder, charging people like me little bits of commissions and hidden exchanges.
But times millions and millions and millions of customers is an awful lot of money. Why
do you think it's taking so long for even people like me to switch on and realise that and move to one of these kind of neo or challenger banks?
When I talk to people about this, some people are bothered about it because they don't like to be ripped off, even if it's a few pounds. But they'll say, okay, well, it cost me an extra 20p, or it cost me an extra £5 on this transaction. But they won't realise they're using that card time and time again. If you typically spend £2,000 on a holiday or £5,000 on a holiday, you're probably paying hundreds and hundreds of pounds every single holiday. But people sometimes think, oh, I just like the convenience of everything being on my Amex card, or my company pays my Amex card, and I can't be bothered with it. But everybody thinking that way means that these companies have no motivation to change. But if you look at the way that, I guess, Revolut's a good example, we're a good example, where we actually give you as close to the mid-market rate as we can.
What's the mid-market rate? Is that just like the average?
Yeah. So really, there's no spread. We're removing the spread. We're saying
forgive me, what's the spread?
The spread is the difference between buying and selling something. Basically, it's a profit margin that an FX company will make. So Travelex is a really bad example, a good and bad example, where you go to the airport and their spread is massive. They even show you their spread, isn't it? It's transparent because they're transparently ripping you off, so it's okay.
And that's what the regulators are doing, is forcing them to be that.
Yeah. Show me what you're going to buy. So if I came back with £100 of euros to Gatwick Airport, what would I get for it? And they'd probably give you, I don't know the exact rates, but that they would give you less than if you were to buy £100 from them, and that is the spread, the difference between what you're buying from them and what you're selling from them.
So does that mean these more modern institutions have traditional banks in each country? So like if I take my card and I go and buy something in the States in dollars, buy something in pounds, there's zero costs for the foreign exchange because you're not changing between dollars and pounds, or you're taking dollars out of a local bank in the States? Or?
If you were to use, for example, my company, Ziglu, you've got two choices. You can either you arrive at JFK Airport, Terminal 3, you go to buy your Starbucks coffee. If you've bought currency before, you can buy US dollars before with us and hold it in your US dollar account, and then you spend like a local.
On the same card?
On the same card, that's right, yeah. So it just knows where you are, and it gets a US dollar request in from Starbucks. I want a 4-pack, something stupid for your coffee, probably $7 for your coffee or something stupid. So if you've got $7 in your account, it will debit your US dollar account. If you haven't, it will do a conversion at the mid-market rate against your sterling account. But if you were to use your Amex card or your Barclays card, they set the rate themselves. So they say, right, we're setting this rate, and it won't be the mid-market rate. It will be whatever rate they want to charge. And often, not always, but Amex certainly do, they'll charge you a commission, i.e. a fee for doing that for you as well.
And that's why they can give you all the fancy perks and benefits.
Exactly.
So here's a question for you. Some of these, you call them challenger banks, in the sense that they challenge the kind of old school industry. A lot of these have products where you can earn yields on things like, let's say you've got Solana, or you buy Ethereum, or you have Bitcoin. It allows you to earn like I want to call it an interest, but they give you like 2 to 6% or whatever. Where does the money come from to do that in a challenger bank? So not the old school infrastructure. I get that they have their scams and their rip-offs. I understand that sort of. Where does that magic money come from?
So challenger banks don't do that because banks don't provide cryptocurrency. There's very, very few. There's probably one or two that provide cryptocurrency that have come in from Europe. But none of the banks, the Starling or a Monzo or a traditional bank, currently enable you to provide cryptocurrency. Revolut do, Ziglu do, and one or two others do. So what we do is, when you deposit money with us, or you deposit money with any bank, they can lend it out. They give you interest on it, or they don't give you interest in 9 times out of 10. They lend that money out to customers that want to borrow money, i.e. on overdraft at the rates we talked about, or they can take that money and lend it out in the market, in the money market.
This is where you talk about like the overnight fees.
Yeah. There's a number you can do it. You can do it overnight, and the interest rates will be based upon who wants to borrow that in the money market, which is a global market of borrowers and lenders of different ratings, and you get higher interest rates for lenders who haven't got maybe a AAA Moody's rating and or governments that haven't, and things like this. So basically, the banks lend this money out overnight and receive interest, or they can lend it out for term deposits as well.
This might be a weird question, but why? What do you mean by like overnight? What, someone needs to just borrow some money through the night?
Well, yeah. Well, overnight in the UK isn't overnight in all parts of the world.
Yeah. Okay. Yeah. Fair. It's maybe a dumb question, but
it's kind of how it works. But so when you're lending this money out, your money that is being lent out, you're not going to get that any benefit. The bank's not going to give you that. They're transparent about not giving you, of course, but they're not going to give you that money. They get the money. So what we do as a company is when we have your cryptocurrencies, or when we have your fiat currencies, we give you the option of, do you want us to lend that money out on your behalf and give you the interest. And we do that so we're kind of trying to saying, look, we benefit from this money. If you want us to give you that money back, then we can do that. If you give you the interest, we'll give you that interest. And that's what we do as a company. There's a few companies that do that, but not many. But we do that from a number of currencies that people want to borrow overnight or for a term period, and we give you that interest back.
I know that this might be a tricky question to ask you, and for those listening might suggest that there would be a bias, but the risks involved. These money markets, these overnight things where as a company you hold money and you go and rent it. If I said, I'm going to go chuck a bunch of money into one of these lending protocols, if you say, is there a world where the money markets implode and all of a sudden my cash is gone?
Well, there are risks, and I think that's something that you need to be aware of, and in the explicit terms and conditions and agreements, you are taking a risk in us doing that. Absolutely. So it is made clear that there is a risk in doing that. But the banks obviously don't make. I mean, they're not giving you the interest, therefore they don't need to explain the risks to you, because they're effectively doing it with your money without your knowledge. So, but there are some risks because markets fail. We've seen it a few times over the last 100 years or so. So yeah, there are some risks.
And is that what it would take when we talk about risks? Would the whole market have to essentially fail in order for?
Not necessarily the whole market. We saw a couple of years back in crypto, there's a big company called Celsius, went down, 3 Arrows Capital, Terraformer, Voyager. A few companies failed that deal with cryptocurrencies. So there can be sort of smaller failures that do impact the marketplace. But I don't believe many of those impacted UK retail customers. They did in US retail customers, of course, but not in the UK. But there are some risks in doing that. But those risks, I think, are explained, and when you sign up to those kind of products, it's quite clear. It has to be clear.
Yeah, and I think while in statement it's probably clear to most people in writing, I think for many it's trying to understand that barometer of risk.
Yeah.
It's like, is it that we go into a recession and then all my money could go, or is it no, like a nuclear bomb has to go off?
Well, we have to make it absolutely clear that there's a risk. We can't, in every statement you'll be aware, Mark.
Is it
in every statement,
can't imply whether it's a small or a big risk?
We can't. We just have to say there's risk. Yeah. We can't.
You couldn't say
everything's a big risk.
I mean, I guess I can say what I
in
like,
crypto.
But so you could, it could be the case that like the entire world would have to implode for it to be a risk, but you couldn't suggest that that's a small or big risk. That's interesting. No. But I guess that's kind of nice in a way, because it means that you are standing by the principle of not interfering with someone else's decision and their own education to make that choice. That's cool. So here's a question for you. Bitcoin, Ethereum, Solana, XRP, they all seem to have different rates that you can earn on them. Why is that? Is that because you lend out XRP, or do you turn the XRP into pounds and lend the pounds?
No, you're lending out those currencies. So it's the demand, it's the supply and demand of those currencies.
On a currency by currency, you don't just turn it all into fiat and then lend it traditionally.
No,
it's
actually lending. You lend that currency out. That's right.
Fascinating. Okay, then right. So that's why I would need to put the coin into that specific wallet, for example.
Yeah.
Okay.
That's right.
That makes sense. Fascinating. Okay, so I know that with all my guests, I could end up talking around the houses for hours and hours. But as I start to think about some of the final key questions I'd love to ask you, how would you personally share your experiences in starting a business and building a business and being an entrepreneur in this sector? What would be your advice?
Well, it's hard, but if it wasn't hard, everyone would do it. And you've got to be up for taking risks, and so has your partner, and family, and friends. And not everyone is and is able to. For me, it's really interesting. I love it. I wouldn't want to do something that was a little bit more traditional, let's say, in many ways. I love what I do. I get a buzz out of what I do. But it's really hard to try to mould a team of people, focus them in the right direction, keep keep a degree of momentum going, grow a business with the backdrop of massive regulation and oversight by regulators. Now, I think it's a good thing, and I think it's important that we have high levels of regulation. For us, it's worked to our advantage, where many companies have left the UK and European marketplace because they weren't operating to the standards that the regulators expected, and I think that's left a marketplace left for people that are operating at the highest level and making sure that consumer protection is in place. And the rules, as I think you know to some extent, Mark, are really, really high. And there's a really, really high barriers to entry into the marketplace now. So those that operate have to operate at the highest level, and there's a lot of scrutiny over that. And I think that's good. But I wouldn't be exaggerating to say probably almost like a third of my staff are focused on FCA regulated compliance risk management functions to try to make sure that everything that we do follows all the regulations and rules, etc. And it's pervasive across every single function, whether it's marketing, as you'll be aware of, in terms of what you can say, what you can't say, and all the hoops we have to jump through to get compliance on statements. And if you want to respond to something that's going on in the market right now, it still has to go through our regulatory process for our head of compliance, our MLRO, our risk management function to sign off and approve everything. That, even if it's something you want to get a tweet out in half an hour or even less, you can't, because you've got to follow these things to make sure it complies. But it's good that it's good, and you know. I enjoy the pressures of doing what we're doing. I enjoy growing a business. I enjoy the fact that, you know, I love, you know, seeing people use our cards out on the streets, you know, buying a coffee and see someone using a. I remember the first time when we did when we did Starling and seeing people using Starling cards for the first time, and I was thinking, like, I kind of built all that and made all that work. And the same with Ziglu. I'd kind of love people using the card and knowing all the effort that's gone into making that card work. I was in Dubai once, and I was also in France once, and seeing someone use my card, you know, my Ziglu card in those places.
Must have been surreal. It
was great. It was really great, and and knowing what it takes to make that work, and from putting that down in that shop to us authorise it and acknowledge it within 300 milliseconds, 200 milliseconds as we have to make the whole solution work. It's kind of like, it gives me, you know.
Well, we don't think about that stuff.
Technically, it's quite hard to do, but we designed and built all that from scratch, and that's the cool stuff.
Well, as a consumer, we don't think about that because you're right. When you hit the card, you've got to talk to the ledger at your place. You've got to reconcile everything. You've got to let the retailer know that it's okay to take the money out, and you've got to do all of that in a
200 milliseconds. Yeah, which is 0.2 of a second. That's right. Just for people that don't know. Yeah.
So
yeah, I think it's about like
seeing the cards.
And building all the components that.
It's the milliseconds of how.
Yeah.
Well, because we don't think like that. The fact that you have such a big machine in the background that has to operate at such high speeds, we just want our card to work and our coffee to come. You know. Yeah.
Well. Can you imagine if you're in Australia, where in Australia you're putting your card down, it's talking to the local retailer. That local retailer then has to talk to your processor, looks at the details on the card, finds out where your processor is in the world, connects that processor. The speed of light is only the speed of light, 186,000 miles a second. Yeah. So
it's all right. No one's going to check. No one on the internet.
No.
Over 1,000 comments, isn't it?
I might have got out by an order of magnitude.
Really quick, super quick.
186,000 miles a second, yeah. But, you know, Australia's a long way away. So you've got to make sure that you still have to do that within certain defined times by MasterCard in our case, to make sure that you can acknowledge it back so that the queues don't build up globally. So all those things have, you know, you have to make sure that when it comes to us, we provide the acknowledgement back and then we reserve the money and move it off the account. Because what we find is people will try and do two things at once. They'll try and make a payment at the same time as using a card to better clear out their account, all that kind of stuff. So it's all kind of quite tough microsecond stuff, yeah.
As an entrepreneur, as someone building businesses, I always like to ask the question, what are we going to talk about in 5 years' time? So when we do this again in 5 years down the road, what would you like to have achieved and why?
What would I like to have achieved? Crikey, okay. I want to build this business up to be a significant player globally. and employ lots of people and enable them to get a really fulfilled role that they really enjoy doing and learn some stuff to be able to enable them to go on to something else that they want to do after that. So for me, it's about giving people an environment where they can really learn some stuff and enjoy it. Maybe you could argue that's kind of what the Google experience is in many ways, and how people working for Google, I think they've got kind of in many ways a privileged kind of lifestyle, but you have to work hard, you have to be good. So I want to be able to enable that kind of capability here, whereby people can work for us. Our standards are really high in terms of the level of people that we employ. You have to be good at what you do. But if you get through the door, then you need to be kind of looked after and have the ability to be able to do a range of different roles. And anyone can come up to the CEO's desk and ask him a question, or anyone's desk and ask him a question. That kind of culture of acceptance, that culture of I want to listen to you. Have you got some things that will help our business? I think is really important, which is kind of the opposite to the days in Barclays, where there was offices and doors, and as you moved up the hierarchy, you got arms on your chairs eventually, if you were lucky, and that was kind of the hierarchy of the banks. And what we're trying to do is kind of say you don't need that to be successful. In fact, if you employ good people, all those people will contribute to your success if they're focused in the right direction, your culture's right. And there's nothing more important. In terms of importance of employing somebody, it's a culture that's more culture and values and attitude and motivation is more important than skill set, because they can learn some of the skill sets as long as they're intelligent people. Therefore, culture and values are the most important thing in terms of people that work with me and for me. But I just I want people to have a good time, but I want people to have a good time at the same time as making sure that we do the right thing for our customers, and we all have fun.
It's fascinating to listen to someone from a financial background, not looking at kind of growth metrics, or I want to be in these countries, I want to do this revenue. For you, it is really just about kind of your squad, your people. It's very much a people-orientated answer.
If you haven't got those people pulling in the right direction, there's no point. I've got some of the things at the back of my mind I'd like to do in terms of growth, but because I've got stakeholders, other stakeholders, shareholders and investors that expect me to grow, expect value appreciation. But you're not going to get that unless you focus on the people that help to drive that for your business, your staff. Fascinating.
Well, I've got to say, thank you for taking the time to do this. I know you're a very, very busy man. I know you've got a lot of challenges as always. What's next on the agenda for Ziglu in 2025? What are you planning just before we wrap up?
Well, we've got expansion plans in Europe. We just acquired a business in Europe, so we're pushing out into Europe, and that's a big market for us. It's a 450 million person adult market, bigger than the US. And we're looking to get our product out into Europe, which does all the things that we do in the UK, but also stocks and shares, US, UK, investments and all those types of things. So some really quite cool things across each of the European countries, and that is kind of like difficult, because do we do languages, don't we do languages? And turning them on in market at a time, which markets in which order, it's going to be quite an interesting challenge next year. And then we need to be planning for the next year after that. So we've been doing our 25 planning recently, a bit late arguably, but we kind of knew what we were going to do. And then we want to start thinking 26 planning. So what are the things we want to plan for 26? Because everywhere you move, you need to be able to have licenses ready for those different jurisdictions as well. So licenses can take a year or more sometimes. So we need to be working out where we're going to be so we get the licenses in place to support that growth.
Well, I'm going to be watching eagerly, as you know. I can't wait to see your success with Ziglu. It's something that I've used myself, and I've got to say it's really cool for me as someone that's loved crypto for a little while, seeing it now being absorbed and adopted by the masses, seeing infrastructural kind of licensing and this, let's say, acceptance, not just from people but also from regulators and governments. And I think you've clearly been a big part of that. So thank you for what you're doing. Good luck with everything. I look forward to our chat in 5 years' time.
Okay.
I'll see you when I see you next.
Thanks, buddy.
Thanks, Mark.
Cheers.
Brilliant.